The rush is on to claim correlation between gold and interest rates. Statements such as prospects of higher interest rates have the ability to limit gold's upside gains. Since gold has a zero yield, it tends to lose its allure in a high interest rate environment. Or, because gold doesn't bear interest, it struggles to compete when interest rates rise. The implied correlation suggests that higher interest rates result in lower gold prices and vice versa, but that correlation does not exist. Between 1970 and 1980, the price of gold rose from $35 per ounce to $850 per ounce, a 24-fold increase. But rather than declining, interest rates were on a tear. The 10-year U.S. Treasury bond yield more than tripled from 4% to 12.5%. Rather than struggling to compete, gold was galloping ahead in the face of ever higher interest rates and increasing lack of demand for higher yielding investments. The higher rates were a reflection of lower prices for bonds and fixed income investments and resulted from significant inflation concerns and a very weak US dollar, which makes you wonder when you read something like this. Higher rates boost the value of the dollar by making US assets more attractive to investors seeking yield. Just the opposite happened during the years 2000 to 2011. While the price of gold rose from $250 to $1,900, interest rates on the 10-year U.S. Treasury bond dropped from 6% to 2%. Two decade-long periods of outsized gains in the price of gold, and interest rates were doing something entirely different during each period. There is no correlation between gold and interest rates.